Welcome, and thanks for tuning into KBRA podcasts. We cover topical research discussions, industry commentary, and more. In today's episode, we have a cross-section of KBRA speakers on the issue of globalization. Joan Feldbaum-Vidra, Global Head of Sovereigns, is moderating this episode. She's joined by Ken Egan, Associate Director in Sovereigns, Michael Labuskes, Senior Director in Transportation, and Hesser, KBRA's Chief Strategist. In this episode, they discuss recent developments in global trade, COVID-related recovery priorities, and underlying developments that work towards enhancing global connectivity. Stay tuned to learn more.
Greetings and welcome to the next episode of KBRA Podcasts. The Sovereigns Group has really enjoyed doing these podcasts, and today we are thrilled to reach across the aisle to discuss globalization. Mike has very interesting insights that support some of the key things that we think are developing. And Van, as many of our listeners know, has interesting insights about the tie-in of globalization to global credit market conditions. But first, you'll hear from me and Ken to provide the Sovereign Group's perspective on globalization. Globalization is a topic we've been writing about a lot, but I'll have to say we've switched gears somewhat, and a lot of our newer thinking relates to the pandemic as the world endeavors to re-equilibrate. We used to be much more concerned that deglobalization was underway. Think to Trump and Boris Johnson. After all, Brexit is a perfect example of severing existing trade arrangements. But the pandemic has to some extent paradoxically changed our minds. Plus, the data is quite informative that globalization is not going away anytime soon. Before I reach out to Ken, my colleague in Sovereigns, let me just set the table. Here's the data. World trade growth has averaged well above 3% since 2012, really quite in sync with overall global GDP growth, just shy of those levels. There was a marked change in world trade in 2019, when global trade decelerated sharply to 1%. And then COVID hit, and global trade contracted by about 8.5% in 2020, according to figures from the IMF. But what is in store? Many forecasters believe that global trade growth in volume terms will exceed GDP growth in the medium term for the globe. IMF forecasts are for global trade to grow by 8.4% this year and 6.5% next year, versus GDP growth of 6% this year and 4.4% next year, making up for the lost ground in 2020. Well, is that a trend here to stay? In general, at KBRA, we think so. The world is more intertwined than ever, and disentangling the linkages will not be easy and won't likely be expedient in many cases. The bottom line, in our view, COVID-19, and on a smaller scale, the Suez Canal blockage, put global supply chains in the spotlight once again and showed us how rigid supply chains can be very crippling. This is very important to sovereign risk for countries heavily reliant on trade, such as Germany or Asian economies. It is also important to sectors where the bread and butter is trade, such as shipping and highly internationalized corporates. So this change in perception is meaningful to our credit views. Turning to my colleague, Ken, who sits in Dublin and is an expert on European sovereign credit. Ken, would you provide more of a backdrop and build upon my introduction? Also, could you focus on the seeds for sentiment around deglobalization so we can make sure we provide a balanced picture?
Yep, sure. I'll provide a refresher on recent developments. The global COVID-19 pandemic quashed demand, and in the early months of last year, floored world trade. Mobility restrictions put in place almost everywhere around the globe ensured logistical nightmares for companies, which ultimately led to backlogs. And then more recently, geopolitical trade tensions have escalated. If you think back at the end of 2020, a trade deal between the EU and China seemed promising after years of negotiations, and it looked like we were embarking on a new era. Here in 2021, that now looks, to quote European Parliament member Bernd Lang, put in the freezer. At the start of the month, the European Commission announced plans to reduce dependency on Chinese supply in various sectors, such as pharmaceutical ingredients and semiconductors. And I guess we're all seeing the semiconductor supply risks to economic growth and inflation. The EU wants to move away from its reliance on China for certain products which are sensitive to the ecosystem and go against the bloc screen agenda. The economic scarring of COVID-19 pandemic has prompted the EU to rethink its dependencies on global supply chains. And I have a quote here from an EU document on the issue saying the measures taken against China look at diversifying supply and demand, relying on different trading partners wherever possible, but also stockpiling and acting autonomously wherever necessary. Meanwhile, US and China trade representatives are due to meet in the coming weeks, and there are also meetings on the horizon for the US and its most important trading partners, Canada and Mexico, signatories to the USMCA. So far, President Biden has not flagged any plans to remove trade tariffs on China that were imposed during the Trump administration. The planned meeting is to assess the implementation of phase one of the trade deal, but make no mistake, trade tensions are high. Further problems could emerge from the domestic political sphere later in the year when elections in Germany could see the Greens get into government. Now, the party has a hard line against China with regards to climate and human rights, and elsewhere, in line with its own green agenda, the Greens could look to change German industry in favour of a more sustainable future. Could this transition impact one of the more traditional powerhouses of manufacturing, and how will it change the global supply chain where Germany is a cornerstone? ESG stakeholder risks are high for China beyond just Germany because of its carbon footprint, even as momentum towards renewables is also very strong. So I guess from here, it's not too difficult to see why there's so much market talk about deglobalization.
Thanks, Ken. In order to get a view on how interconnected the market is and whether this narrative of globalization is progressing, what indicators should we look at and what is the data telling us?
Yeah, so the European Commission and the OECD look at various indicators like FDI, research and development, digitalization, and international trade, and we can explore some of those here. A more obscure indicator that the OECD and the European Commission look at is innovation and R&D spending. In its March release, the OECD said that research and development investment grew by 4% in 2019, continuing an upward trend. According to the report, following a stagnation between 2013 and 2016, R&D intensity in the OECD area has been steadily rising. In fact, the OECD area has not seen comparable growth over a 3-year period since the mid-80s. Growth in R&D intensity was widespread across most OECD countries in 2019, with world trade leaders like the US and Germany at the forefront. Crucially, despite the onslaught of the pandemic last year, the OECD expects growth in R&D for companies was on average 6.2% for the year, compared to 9.3% for 2019. And this tended to be concentrated in communications technology, which also ties in with ongoing structural changes in digitalization, which I'll come to in a minute. Governments were no different. The OECD reports that as of March 2021, government budgets for R&D increased in 2020 from 2019, 6.2% from 3.2%. So the world is more interconnected than ever before. Technology is a huge part of that. The more technology advances, especially in the realm of communications and transportation logistics, the more codependent we become. And that's just reality. Such ties are hard to break. Outside of that data, we can also think of some themes that help interconnectedness, like digital currencies and blockchain technology. Cryptocurrencies, for example, are already under review by major corporations and even central banks. The ECB has already highlighted plans to review its own digital euro. And maybe a further reach from this, Benoit Cœuré, who sat on the ECB's executive board, left the central bank to take a position with the BIS heading their innovation hub. The media reports that the BIS will look at how to facilitate cross-border payments using a digital currency. So it seems the wheels of trade will become even more easily lubricated.
And digitalization, that also features heavily under the EU's recovery plan, yes?
Yep, that's right. So as part of the EU's recovery and resiliency plan, countries that take part must allocate 20% of resources to foster digital transition. For example, Spain announced it will set aside nearly 30% of its 140 billion euro package for digital transformation. So this will involve things like broadband rollout, 5G fiber coverage, modernizing the online public administration. Over the next 5 years, Europe will become increasingly interconnected as countries look to globalize their own states and business shifts to become more instantaneous by nature. You get the feeling the world is moving closer together, not further apart through digitalization. which is far from complete.
Thanks so much, Ken. That's really helpful and very interesting. And let me add a bit to this. At KBRA, we're increasingly sensitive to the pull of inertia. As countries come out of crisis, it's much easier to go back to business as usual than to restart anew. We are already seeing green shoots of that expectation. Yes, it may take a while in certain strategic industries. You mentioned semiconductors very appropriately, and pharmaceuticals will detract from that pull and create big headlines, but they probably won't offset underlying trends in full. And that reality is, if it's efficient and profit maximizing, we will likely see business as usual. Also, the world's biggest trade agreement was signed, RCEP, in Asia, with very liberal rules of origin, meaning the world's most dynamic bloc in terms of trade and also in terms of growth will be even more highly trade powered. So now I'd like to bring in our esteemed colleague who covers shipping. His industry is at the heartbeat of what we're discussing. Mike, what are you witnessing? And what does this mean for your outlook on shipping?
Thanks, Joan. When we talk about shipping, we need to think in terms of the different major sectors, tankers, bulkers, and containers, because the forces acting on them are very different. There are a lot of other smaller types, but looking at the majors, we can get the picture. The suffering of tankers, crude mostly, continues. The nascent recovery hasn't flowed much into crude demand yet. And now there are fears in the space of loosening of Iranian sanctions that could instantly add nearly 220 vessels into an already anemic market. I'll save containers for last, but their stellar results have had some spillover into bulkers, as some traditionally bulk materials have been migrating into containers for ease of moving multimodally. But now, because of the constraints on container shipping not being enough supply in that space, some of that has moved back into traditional bulk shipping. That has had an uplift in day rates in that space, but they've recently seemed to be stabilizing, as there's also some dampening effects going on there as well. An example of that, I think it's interesting, is iron ore in Brazil. The production of it has been down because of the pandemic, and iron ore consumption in India is also down for similar pandemic-related workforce problems. So one end is hurting supply, the other end is lowering demand at the same time. So there's a lot of odd things going on there, and the sooner that the virus contagion gets under control in those economies, the sooner we'll have more buoyancy in production and demand. That's our expectation there. Containers are enjoying the most profitable period in recent memory. A lot of this is consumer demand. Utilization is very high of these ships, particularly from Asia to North America and Asia to Europe. It's also high from Europe to North America. The biggest problem now is that the demand is far outstripping supply, with knock-on effects such as shortages of actual containers themselves and unprecedented delays at ports and terminals. And part of that's due to labor issues, again, from the pandemic, but also just constraints on how much volume the ports can handle, which of course causes more spillover into other more tertiary ports. So if anything, the COVID-19 pandemic or the blockage in the Suez Canal will make global supply chains more robust. Digitalization, automation are being accelerated, terminals will adapt to the volume, and most ports, primary and secondary, will expand as needed. It just takes time. Companies will learn from these events and adapt by charting new routes, diversifying supply, and bulking up inventories. One should never talk about the long term in shipping, but for the near term, credit perspective, containers look great, bulkers should be okay, and tankers will continue to struggle.
Mike, thank you. Ken, let's turn back to you. Do you want us to help dig more deeply into trade data? Recent data seems to suggest that signs of global trade faltering are not very pronounced, to put it mildly.
Yeah, so despite the narrative of protectionism, trade figures so far tell a different story. international trade seems to be roaring back and in some cases surpassing pre-pandemic levels. So looking at the bigger players and maybe throwing some figures out, EU total trade with the rest of the world in Q1 this year saw imports up 19% on the year and exports up 10% on the same period. And just for some background on last year, total EU trade with China and the US has been increasing since 2015. And although international trade might have taken a hit through the pandemic, EU-China total trade and EU-US total trade for 2020 was above the running average since 2015. China's trade figures have been very encouraging this year. Foreign trade is up nearly 30% for Q1. And within that, trade with the US was over 60%. And back in February, Chinese exports in dollar terms gained over 150% compared to the month a year earlier. Further afield, Japanese exports grew by the most since 2010 in April, rising 38% on the year. And even with the base effect, that's a massive jump from March and a clear sign of the surging global demand. The US trade deficit has risen nearly 10% in 2021 alone, reaching a record earlier this year. South Korean trade has gained rapid momentum, and Australia posted good export readings for Q1. As you might expect post-Brexit, the UK is slowly into stride, but month on month this year, the figures are going in the right direction. And looking ahead, the UK government has introduced various new incentives as part of its March 2021 budget aimed at boosting export. Incentives like R&D tax credits and the introduction of free zones across UK ports acting as low tax economic areas. The final point I'd add is that the global output PMI indicator for services and manufacturing is now higher than pre-pandemic levels. So it looks like despite all the market talk about deglobalization, it appears international trade is booming and it's business as usual.
Thanks, Ken. That's great. Now let's turn to Van, who is going to share with us what this means for the global credit environment.
Thanks, Joan. What a difference a year makes. COVID-19 opened our eyes to the vulnerabilities of all sorts of relationships, conventions, and trends. But with 2020 hindsight, it also showed how durable many of these things have been, not the least of which is globalization. As my colleagues have mentioned, trade flows have returned to pre-pandemic levels, investor flows have remained global, and information flows actually picked up considerably as technology stepped up to pull the world closer together during lockdowns. From a market's perspective, for much of the past 6 months, risk assets have been priced for perfection in an imperfect world. So despite rising geopolitical tensions and plenty of uncertainty regarding the pandemic, the broadly held consensus view is that the vaccines will work, paving the way for economies to get back to normal in relatively short order. There is no room for disruption and added costs that come with broad redesigns of workflow. Over time, we expect businesses and governments to think about reducing vulnerabilities exposed during the COVID period, but for now the focus is on doing what you can to meet surging demand. If you're a business, maintaining margin has become paramount, making cost-effective access to materials critical. The prospect of inflation has emerged as the number one concern among investors, and if higher costs of materials are to be truly transitory, then all of those global supply chains will have to remain open. And with a few exceptions, most notably semiconductor chips, that appears to be happening. That will keep the global economy in recovery, in our opinion, and credit defaults very much under control.
Thank you, Ken, Mike, and Van. Really fascinating stuff. I think our listeners can tell that there are a lot of minds at KBRA that are thinking about this topic. Signing off until next time, and thanks for listening.
Thank you all for your interesting insights. This concludes our episode. Please feel free to continue the conversation on LinkedIn and Twitter at Crowbond Rating. We'd also like to remind you that all of our ratings and research reports are free at KBRA.com. Lastly, if you have any idea for a future podcast or would like to share your feedback with us, please email media@kbra.com. See you next time.